Hello everyone, welcome to my Risk Management Lecture Series 4. I am Professor Senyukta. I am going to cover in this today's session the following learning objectives. Our first topic is important financial risk. What do you mean by the term financial risk? We'll see, and its different types. Market risk, which is also one of the financial risks, the meaning of market risk. Different sources of market risk, measurements of market risk. This we are also going to cover in this lecture today. And VAR, that is value at risk. The meaning of VAR. Coming to financial risk. What do you mean by the term financial risk? If there is a chance of loss to money, we say it is a financial risk. So types of financial risk: market risk, that is risk due to the volatility of the stock market. This is a financial risk because that leads to the loss of money. Then next one is credit risk. Credit risk arises when there is a chance that the borrower of money who have borrowed money from you fails to pay back the principal along with the interest. Operational risk. This is also a kind of financial risk where as soon as a business starts operating, there are various kinds of operational risks that are related with the business. It can be due to internal factors like failure in production, labor strike, etc., as well as external factors such as changing government policies and all that. So they are termed as operational risk. And the most important fourth one is investment risk. So whenever you are investing your money somewhere, we are expecting that our money should be, the investment revenue should give this kind amount of return, but in reality we are getting less rate of return. So this is investment risk. Now what is market risk? Market risk is the possibility of an investor experiencing losses due to factors that affect the overall performance of the financial markets in which he or she is involved. This is in simple terms we can say that market risk is the likelihood of loss due to the fluctuation or volatility of stock market. Now, market risk, it is also termed as systematic risk because it affects the whole system. You can say that. So all the companies gets affected due to the fluctuation of the share market. And this cannot be eliminated through diversification. How can you eliminate it? When the whole system is affected, the whole economy gets affected due to the fluctuation of the stock market. So it's not possible to diversify this market risk. But it can be hedged against, that means it can be minimized. Now, another more thing that I want to see and tell here is that market risk is it affects an entire market or asset class. So systematic risk, yes, talking about the market risk is systematic risk. So you can say that it is undiversifiable risk also because it affects all asset class and is unpredictable. So an investor can only mitigate this kind of type of risk by hedging a portfolio, and that's the only way. Okay. Now we move on to the different sources of market risk. We'll have a look at the different sources of market risk that are there. First is the equity risk. Now, what is an equity risk? Is the risk involved in the changing prices of stock investments. You can say, right? Now, if you are investing in shares, you are buying shares in a stock market, then obviously as the stock market will fluctuate, your values of the shares that you have invested may increase or may decrease. So whenever it is increased, we don't say that is the risk. But whenever it decreases, we say that there is a risk. Oh my God, the stock market is so risky. So that is the risk associated with the stocks that you invest or equity that you invest. That is termed as the equity risk. Next is the commodity risk. This is the volatility in the market price due to price fluctuation of a commodity. So commodity risk, it affects various sectors of the market such as airlines, casino gaming. A commodity's price is affected by politics, seasonal changes, technology, and current market conditions. You can see also. Now, for example, you can say that suppose there is an oversupply of crude oil, which has caused oil prices to fall every day over the past 6 months. So, now a company that is heavily invested in oil drilling wells faces commodity price risk. As a result, what will happen? The company's profit margin will fall as well since it's still operating at the same cost, but the prices of crude oil are falling. Its profits will decrease. The company could use futures or options to hedge this risk and minimize the uncertainty of oil prices. So it can be hedged, but you cannot eliminate that risk at all. The next one is currency risk. Currency risk, you can say that it's an exchange rate risk that arises from the change in the price of one currency in relation to another. Investors or firms they're holding assets in another country are subject to currency risk. So we can say that it is a form of risk that arises when there is a volatility in the currency exchange rates. Global firms that operate in a number of countries, they may be exposed to currency risk when conducting business due to imperfect hedges. For example, also here we can say that suppose a US investor has investments in China, the realized return will be affected when exchanging the two currencies. Assuming that you can assume that the investor has a realized 50% return on investment in China, but the Chinese yuan is depreciates 20% against the US dollar. So due to the change in currencies, the investor will only have a 30% return. So this risk can be mitigated by hedging with currency exchange traded funds. And that is the only way. Coming to the next category or sources of market risk is interest rate risk. Now, interest rate risk, this is actually, you can say, the volatility that may accompany interest rate fluctuations due to some fundamental factors such as central bank announcements related to changes in monetary policy. This risk is most relevant to investment in fixed income securities such as bonds, right? Now, interest rate risk, so in simple terms, we can say that it is the risk of increased volatility due to a change of interest rates. There are different types of risk exposures that can arise when there is a change of interest rates, such as basis risk is there, option risk, term structure risk, repricing risk, etc. We are not going to discuss all these things in details. We are going to discuss in the next consecutive lectures about the details about the different interest rate risks. Now we move on to measurements of market risk. First measurement, arithmetic mean is there for return. Geometric mean also gives a good amount of return, that is CAGR. Variance, we have already seen that variance is a good measurement of risk. So it can also be used to measure the market risk. Beta. Beta is another relevant risk metric. This also measures the volatility or a market risk of a security in comparison to the market as a whole. So beta, we can say that it measures the sensitivity of a company stock with respect to the market return. That means if we can say that if beta can be positive, negative also. So if it is positive, we say that if there is a suppose we say that value of beta is plus 2. That means if the market is moving in a plus direction, the company's share will be uh, plus direction will also increase, but the share of the company will get double than the market return. If it is minus 2, we can say that uh, it will be negative direction. So if the market is giving a positive return, the company's stock will give a negative return, and that also twice that of the market. So this is a sensitivity measurement between the market return and the company's return. Another one is very important that we already talked, that is the value at risk. So where it is a very important measurement of market risk. Now we are going to discuss value at risk meaning, because this is a new measurement that we are learning. The beta we have already covered in CAPM model, that is capital asset pricing model. We have seen about this, and most of us know about beta and how to find it out. Also in the consecutive video lectures, the link I will give in the comment box, where I will give a detailed link of the video that where we are going to discuss in detail about CAPM modeling, where we will see how beta is calculated and what is the significance of beta. Now here, our next important measurement is VAR, that is value at risk. Now, a VAR statistic, it has a three components. A time period is there, a confidence level is there, and a loss amount or loss percentage is there. So what is the most I can expect to lose over the next month? And that is predicted with a 95% or 99% confidence level. This is VAR, right? Now, what is the maximum percentage with 95% or 99% confidence expect to lose over the next year? The VAR question has three elements. If you will see, what is it? A relatively high level of significance, that is 95% confidence level is there, level of confidence, and 99% level of confidence is there. So 95 and 99%. A time period is there, in a day, month, or a year, and an estimate of investment loss, that is expressed either in dollar or in percentage terms. So in case of dollar, we can also use different currencies. So this we can say another thing before moving on to our end. Here I just want to say that VAR, if I am saying that the value of a VAR is 1 lakh, what does it mean? 1 lakh at 95% confidence level. What do you mean by this? So if we are saying that the value of VAR is equal to 1 lakh at 95% confidence, that means you are 95% confident that at max you are going to lose 1 lakh. 5% is there, where you can say 5% chances are there that the loss may exceed 1 lakh, but 95% confidently you are saying the 95% chances is there that the maximum loss will be up to 1 lakh, not more than that. This is the significance of that. Now, when we are using 99% confidence, there it becomes that you are 99% confident that the maximum amount of loss is 1 lakh in a day, we can state it in a month or in a year, anything. So VAR is equal to 1 lakh in a month, in the month of January, suppose, at 99% confidence level. This is the statement which is given. This means that you are 99% confident that the maximum amount of loss that may occur is 1 lakh in the month of January. This is the real meaning of that and its significance. Now going to have a look at the different lectures. Topic that we are going to cover in our next lecture: liquidity risk. We'll see what is the meaning of liquidity risk. Types of liquidity risk also we'll see. Estimation, how liquidity risk can be estimated. That's it. So here we end our session over here. Thank you all the students and my different viewers for watching the video. Thank you so much.